While everyone's chasing AI stocks and tech plays, there are two sectors quietly setting up for massive growth, and most investors are completely missing them. I'm talking about fertilizers and energy. I know, not sexy, but hear me out, because the numbers are compelling. The US fertilizer market was valued at $49.4 billion in 2025 and is projected to reach $85 billion by 2034. That's a compound annual growth rate of 6.2%. Meanwhile, IBIS World reports that the fertilizer manufacturing industry has grown at a CAGR of 3.4% between 2021 and 2026, with the industry revenue reaching $39 billion. But here's what makes this really interesting. Recent global disruptions have created a perfect storm for American fertilizer companies. The closure of the Strait of Hormuz in early 2026 has effectively choked off a critical supply route, and US producers are positioned to fill that gap. Let's break down why these sectors deserve our attention right now. Here's what most people do not understand about the fertilizer industry. The US is heavily dependent on imports for certain fertilizers, but that dependency creates opportunity for domestic producers. According to research from North Dakota State University's Agricultural Risk Policy Center, in 2023, 17% of US urea consumption and 20% of DAP and MAP phosphate consumption came from the Persian Gulf region. That supply travels through the Strait of Hormuz, a choke point that has been effectively closed since the conflict with Iran began in February 2026. The impact has been immediate and dramatic. Urea prices jumped nearly 30% within just 3 weeks of the disruption. As of April 26, USDA Secretary Brooke Rollins reported that urea prices have surged roughly 50% in the past month, while ammonia is up more than 30%. Now here's the kicker. The US has strong domestic ammonia production and minimal exposure to Gulf imports for potash. What we do not have enough of domestically is urea and phosphate production capacity. But that is changing now. The USDA is now working with the Department of Commerce to accelerate investment in new domestic fertilizer plants and streamline permitting. Translation: American fertilizer companies with existing production capacity are seeing pricing power return, while new capacity is being fast-tracked. That's a compelling setup. Now let's talk energy. Specifically, the bottleneck that is turning utilities from defensive play into growth stocks. Here's the data. US data centers' electricity demand is projected to triple between 2024 and 2030, eventually consuming 10% of the national total power, according to Morningstar. In 2025 alone, total US electricity consumption rose by 2.3%, the first significant increase in decades, directly attributed to data center growth. And get this, a single AI-related task consumes up to 1,000 times more electricity than a traditional web search. Tech giants like Meta, Microsoft, Amazon, and Alphabet are projected to spend $700 billion on AI buildouts in 2026 alone. This isn't theoretical. US utility companies are planning to invest $1.4 trillion over the next 5 years to update the power grid. That's 20% increase from their 2025 projections. According to Powerlines, 51 investor-owned utilities cited data centers as a top driver of capital expenditure. The energy sector delivered a 16% return in 2025, outpacing the S&P 500, and this trend is just getting started. The physical availability of grid-scale power has become the primary bottleneck for AI expansion, making speed to power the most critical factor for project viability. So why should you care about fertilizers and energy right now? Because both sectors are experiencing structural shifts that create multi-year tailwinds. For fertilizers, the Strait of Hormuz disruption is particularly ill-timed for US agriculture. According to the CSIS analysis, the strait's closure came just ahead of the spring planting season, when fertilizer demand is highest. US fertilizer markets have no strategic reserve, and domestic production cannot scale quickly enough to offset sudden import disruptions. This creates acute pricing power for domestic producers. The Texas Farm Bureau warned that without prioritizing delivery of critical inputs like urea, ammonia, and nitrogen, and phosphate, The US risk crop shortfall, which is not just food security issue, but a national security concern. For energy, the thesis is even more straightforward. The EIA forecasts that US liquid gas exports will rise 1.9 billion cubic feet per day in 2026 to average 17 billion cubic feet per day. Natural gas producers and utility companies with strong balance sheets are positioned to benefit from both domestic data center demand and rising liquid gas export capacity. Bottom line, these aren't glamorous sectors, but the fundamentals are undeniable. Fertilizer companies with domestic production capacity are seeing margin expansion during a critical supply crunch. Utilities and natural gas producers are entering a multi-year infrastructure build-out cycle driven by AI. While everyone else is chasing the next meme stock, smart money is positioning in the picks and shovels that make everything else possible.